Investors, everything I've been saying is going to happen has been happening, inclusive of this recent run-up from earnings and even right down to the very interest rate hike just delivered by the Federal Reserve this past Wednesday. But we're going to get to all of that very shortly. If you're new here, I'm Ari, a dividend investor here on YouTube, looking to dish out all the economic insights and new dividend stock ideas that you're going to need to drive more profits this year and beyond. And today, I have the very economic insights that you won't want to ignore on top of 5 dividend stocks that remain discounted right now despite all the recent rallying, which has made it almost impossible to find some deals out there. Now, enough talking, let's dive right in. So how about we kick off with an account update, whereas my personal account just hit a new record high of $125,951.61, which is truly something considering our economic environment. But I will say, I am not going to be surprised if we falter in the coming weeks. You see, earnings season tends to bring out the emotions in all of us investors, whereas we get really excited to see how our investments performed, but the key is what I just shared in the past tense of perform, because all earnings season really does is allow us investors to see a company's past performance, meaning it really isn't relevant nor shedding much light onto what they face in the future, which is key. And what does our future look like, at least economically speaking? Well, if you're asking me, not too hot. As of this past Wednesday, the Federal Reserve broke their silence from their blackout period, and Jerome Powell announced what I said would be coming down the pipe for us all, despite many others saying it wasn't possible: an interest rate hike. And a matter of fact, interest rates are now at their highest level in 22 years. Now, why does this all matter, especially with inflation actually coming down? Because there will ultimately be implications on businesses, and already we're seeing through mortgage rates an impact on home buyers and all of us consumers. But just wait for businesses to now be pressurized under higher interest rates. Anyhow, Powell's hawkishness didn't even necessarily stop there.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 0.25 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. Inflation remains well above our longer-run goal of 2%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions.
In other words, perhaps I'm going to be right again, and we're going to get another interest rate hike, boosting the terminal rate to 5.5 to 5.75%, all in the name of the Federal Reserve driving inflation down to their goal with the mentality of picking up all of these economic pieces thereafter, because if we don't take care of this matter now, it could be even worse. So what do we do as dividend investors, especially as the vast majority of stocks out there are recently soaring to new heights? Well, you double down on research and due diligence and continue to seek the high quality dividend stocks that are in fact still out there and, better yet, discounted. Which all leads me now to the very first dividend stock on the list, and it's also the lowest paying dividend stock, but one that I do believe will have some solid share price appreciation very soon, which may make up the difference for all of us. Nonetheless, it's Dollar General, ticker symbol DG, which I'm sure you can safely assume from the name is a discount retailer providing various merch and products, whether seasonal or home products and apparel. And over the last few months, as investors have been flocking to join this hype rally, left the General in the dust as we see that drop off and a share price now hovering around $165 per share, which is down 32% year to date with a PE ratio coming in at 15.8. But as the market conditions actually intensify and will surely squeeze the life out of consumers, I think the General is going to be making a comeback, and we already have insiders at the director level and even the CEO himself who are already prepping for that said case by buying shares on top of analysts who are also foreseeing a recovery with the share price coming back up to $195.63. That's 20% worth of upside. And until then, some icing on the cake for all of us dividend investors is the yield coming in at 1.34%. Now, before we continue, investors, help me continue to produce more content like this by simply letting me know that you're actually getting value from these videos. That's all you have to do is tap on that thumbs up button for me, and don't be that viewer who comes and goes. Stick around by simply subscribing to the channel as well. And with that, let's get back to it with our second dividend stock on the list, Discover Financial Services, ticker symbol DFS, which is in the business of financial services providing checking and savings accounts, as well as personal, home equity, and student loans, all on top of credit cards. And while you'd think Discover would actually be up on the year like its competition, Visa and MasterCard, it's actually down by 5.4%, trading only for $107 per share with a P ratio coming in at 7.5. Why? Well, given the banking-oriented segments like checking and savings accounts to lending, I think it's safe to say that Discover is hurting from such diversification, especially when a whopping $2.9 billion comes in from lending services. In the market environment that we're currently in with higher mortgages, less and less opportunity is out there. But that actually means opportunity now for all of us investors, and thinking longer term, smart money has already beat us to the punch, purchasing more shares worth of Discover, while analysts are still holding up their green buy flags as they see Discover coming up to $118.42 per share, making for about 10.5% worth of upside. But investors, the best part about being a Discover shareholder, if you're asking me, is the dividend, as it's coming in a tad over the sector average at 2.3%. Next up, I'll keep this one brief as I've actually mentioned it in a couple of videos weeks back, but it makes for one heck of a solid investment opportunity as it remains discounted right now. We have United Parcel Service, or UPS for short, that doubles as the ticker, which is the world's leading logistics company and one heck of a supply chain management leader since 1907. But we're not here to talk about its history, especially when UPS is trading for $184 per share, which is up on the year but still not near the peaks of $195, with a PE ratio at 15.1. And while it may waver in the near future should consumers resort back to more hardline penny pinching, as businesses likely will also do the same in cost cutting where and however they can in the coming months, we should shrug that off, because as a longer term hold for any portfolio, inclusive of these hedge funds here that have only been increasing their positions with UPS, it's a heck of a steal. Now, as for analysts, of course, there's also optimism there, with UPS climbing back into the $190+ range to $192.20 per share. And until then, all shareholders are going to be able to enjoy the solid dividend that is double the sector average, coming in at 3.36%. Now, over the last few weeks, you've heard me share about a couple different healthcare gems to get invested into, and now I'm going to add another one to the list. It's Bristol Myers Squibb, ticker symbol BMY, which is one of the world's largest pharmaceutical companies that continuously ranks on the Fortune 500 list of largest companies. That honestly, as of late, has been suffering in this high inflationary environment that we've been living in, And even though inflation has been coming down, interest rates are going up, and the company is totally dependent on drug pricing, which has been off the charts lately and therefore creating issues for Bristol-Myers, which is why we're getting this share price at $63.46 per share with a PE ratio at 18.9. Heck, I don't even think you could buy prescription medication for that price these days. But in an evolving market and over the course of time, a turnaround is in sights, and therefore it's a no-brainer to enjoy Bristol-Myers at these lower lows, to which analysts are forecasting a share price coming back up to $74.18 per share, making for about 16.89% worth of upside. And as we can see, we already have plenty of hedge funds who have begun loading up on Bristol-Myers shares. Now, as for the dividend investors out there, all of us, we're all going to be able to enjoy this 3.43% dividend yield. And last but not least, a rather recent personal favorite of mine, Dow Chemical, ticker symbol DOW, which I said was a buy a couple of months ago, and if you bought it then, you would have already be profiting. But why Dow Chemical? Well, it's among the 3 largest chemical producers in the world, with a presence in roughly 160 countries, producing chemicals for an assortment of industry verticals, for products that you're using every single day, whether it's in electronics, packaging, films, tapes, or even personal care products. Dow Chemical is involved. So it's under the radar, but a massive money maker for investors. Now, Dow is in the green, but not necessarily at the heights of where it could be, as it's trading for $53.78 per share today, with a PE ratio at 21.7, which I'd like to be a little bit lower, but considering that it could gain some more momentum, I'm going to overlook it, especially as Dow Chemical has insiders purchasing more shares worth of the company and hedge funds that are doing the exact same thing, given the future expected growth and all the returns to come, as analysts forecast almost 4% more worth of growth, with that share price coming up to $55.91 per share, but could be even more in, say, 6 months or so out. And irregardless, we have a dividend yield coming in here at a staggering 5.33%. Now, there you have it, investors, the 5 dividend stocks that I was able to find amidst all the recent rallying. But now I'm curious what stocks you're looking into right now. Let me know down in the comments below. And if you're already ready for more stock ideas, well, go ahead and tap this video right here. But before you do, make sure you tap on that thumbs up button and be sure to subscribe to never miss a single video.